Hi, I'm Robin with Kell Processing and welcome to my channel. Here I want to teach buyers, real estate agents, and loan officers how to have smoother transactions. As a contract processor with 20 years experience, plus being a licensed loan officer and real estate agent, I've had the honor of being on pretty much all sides of the transaction, and I've learned a lot over the years. Things I would like to be able to tell people that might save them a lot of trouble later on. Now, this is my first topic video, and I've been really wanting to do this for a while, but unfortunately, this is a lot harder than most YouTubers make it out to be. I've been watching YouTube for many years, taking in different content on different subjects, and I really wanted to do this about my industry. So it has taken me several months to get to this point, and yeah, it's a lot harder and a lot scarier. So let's just jump right in. My first topic video is going to be about cash. Now, that's an interesting one because a lot of times people think that cash is not a big deal to deposit in their bank accounts. In fact, there used to be an old phrase, cash is king. This was long before everybody walked around with debit cards and credit cards in their purses and didn't even have $20 worth of cash in their pockets. However, cash is not king whenever it comes to a real estate transaction, and I'm here to tell you why. So most people have heard about the basic different types of mortgages: FHA, VA, conventional. You also have USDA and non-QM loans. Typically, all of these loans, with very few exceptions, are going to require asset documentation. The lender is going to want to see 1, usually 2 months, most recent bank statements at the time of application. They're going to go through these statements and they're going to look for all kinds of things. A lot of these we will go over in another video. But most importantly, large deposits. Now, large is a relative term. The lender may consider a large deposit depending on the sales price of the house. It could be a percentage or a factor of the income, meaning what is large to somebody that makes $3,500 a month is very different from somebody that makes $10,000, $15,000, $20,000 a month. That large is going to be a fluid number depending on the type of file that the lender is looking at. So when the lender finds a large deposit, it is going to have to be documented and explained. Now, that's two separate things. Explained usually means we want a written letter of explanation as to the source of that deposit. Documented is a document to back up that letter of explanation, such as if you have, say, an insurance claim because you totaled a car and that insurance claim had to write you a check. Well, you should have a copy of the check and you should be able to write a letter of explanation in regards to that. Now, large deposits are something that I want to go into more in depth later on, but here I want to talk about the horrible, horrible time that you can have documenting or trying to use assets from cash, which in most cases cannot be done. Now, if it's a small deposit, $50, $100 here and there, $300, most of the time that's not going to be questioned. But if it does come into, say, you had $5,000 sitting at the house that you've been saving up, maybe even 6 months to a year you've been saving that up, it doesn't matter when it comes to cash, because the lender is going to look at that cash deposit as an undocumentable source of assets, and they're going to omit it from your assets used in the transaction. This is a real bad thing whenever those assets are really needed for funds to close, or if there's any reserves needed on the file. We'll talk about reserves another time. So when it comes to cash, it is better if you can season your cash. Now, seasoning is different from sourcing. Sourcing means you explain it and document it. Seasoning means you've had it in the bank account long enough that it doesn't matter anymore. Meaning you can deposit cash, say in January, maybe you've been saving it up again for a while, or maybe your family member gave you a cash gift that they have been saving it for a while. But because they can't document it coming out of their bank account, it's the same as you saving it, and it's the same as cash not being able to be used in the transaction. If you deposit it in January and then you go out and look for a house in a couple months, and you can provide your February and March statements for the real estate transaction, then that January statement doesn't have to be provided, and they consider that seasoned. So it's been in there longer than 60 days. The lender doesn't see the large deposit, even if it went in at the end of January and your statement ends on January 31st. So they won't question it. It's your funds, you're good. But if you deposit that, say $5,000 on February 15th, and you have to provide that February and March bank statement, well, now the lender has seen that deposit. and they can take that $5,000 and minus it out of whatever your balance is at the time, and that is what they're going to allow you to close. If you're short funds to close, then you have to find another access to be able to get those funds to document it for your closing. This also includes earnest money. That's something else that we'll talk about in another video. Most people, if they're in a real estate transaction or getting ready to buy a house or have watched movies where other people have bought houses, they've heard the word escrow before. Sometimes it's escrow deposit, sometimes it's escrow fee. It's just one of those kind of words that's pretty much universal in the real estate world. But escrow is something that you're going to have to put up at the time of getting your offer accepted by the seller, and that money will be put up at the title company. Do not use cash for this either. It may seem like it's okay because it's not actually money that you're going to bring to closing because you're going to be paying it at the time of getting the offer accepted, but it's still part of the real estate transaction and does have to be documented. The lender's going to want to see that earnest money coming out of your account, and if they see a large deposit going in just before it, because again, they're going to be able to see that transaction, they're going to question it. So you do not want to use cash to deposit and then pay for your earnest money, or take cash from your house to buy your, say, cashier's check at the bank, then to take to the title company. So other than depositing your cash well before you want the real estate transaction to happen, 2 months, 60 days, so that the lender doesn't have to see it and won't question it, in what other ways can you use your cash? Cash can be totally from a legitimate source, but at the same time, you just don't want those questions being raised during your transaction. What I recommend to my buyers, if you're going to have, say, a cash source, maybe you do some jobs on the side, maybe you babysit here and there, maybe you just, again, got a small gift from your family member. If it's not something that they can document the source of, then you're better off using it for everyday items. It's a little awkward because most of us are in the habit of just putting in our credit cards or debit cards whenever we go to the grocery store or the gas station. However, these transactions do need to happen. You still have to live your life while you're out getting a mortgage. So those transactions are honestly the best place to use your cash. But really, those day-to-day places are the best place to use your cash. So if you go to the grocery store, you spend $100 on groceries, or with the way groceries prices are now, maybe you spend $200 or $300. You're better off using your cash for that. And then, of course, going to the gas station. So you go up to the pump. I know it's a little awkward. You got to walk into the store and give them the cash and know how much you want to put in. But that can be a great way to use the cash that you have coming in. That way, too, all the money that's coming in from a documentable source, such as your regular paycheck at your W-2 job or your 1099 job, something that we can see the source of those funds, then that can go all to the real estate transaction. This is the easiest way to use cash. The only place to use cash in a real estate transaction is your inspections. So that is the one exception. Most of the time, the lender does not require the inspections as part of the transaction. Therefore, they do not require the proof of payment of those transactions. This can be your structural mechanical inspection and your wood destroying insect report, or what most people know as a termite inspection, as long as you're not a VA mortgage. VAs do require wood destroying insect reports, so it is best if you don't use cash for that. But if you're going on FHA, conventional USDA, those don't require wood destroying insect reports, so you can use your cash for that as well. So in conclusion, to make your transaction easier and to keep you from having to answer uncomfortable questions about assets, you don't want to use cash in a transaction. Not for your earnest money, not for anything but your inspections that are not required by the lender, and not for your funds to close. Any cash that you get, just use it to buy everyday things, and in the end, you will save yourself a lot of trouble. So thank you so much, and I look forward to putting out my next video.